Today we will figure out if Starbucks is currently a buy, a hold, or a sell. And to do this, we will look at three different factors. First, using our stock valuation spreadsheets, we will analyze Starbucks' fundamentals. We will then look into its future growth potential and finally calculate its intrinsic value using our four valuation models. Now, first, let's understand what's been going on with the company. Over the past 5 years, Starbucks has had low or negative growth in profits, and therefore their stock price has been declining. Now, in August of 2024, they hired a new CEO who is set to bring a lot to the table, being a turnaround for Starbucks and making them the giant they once were. Now, jumping to our stock screener, we can see that Starbucks is a dividend company. They currently have a dividend yield of 2.51% with a dividend payout of $2.44 and a trailing free cash flow payout ratio of just below 70%. But as Starbucks isn't a company in the innovation stage anymore, I don't really mind them having such a high payout ratio as they don't need to direct a lot of their free cash flow into innovation. Now, jumping straight to the 9-pillar analysis, we can see that the company gets a rating of 6 out of 9 with 3 pillars currently in the red. Now, first, let's have a look at their profits growth, and that is their revenue growth, free cash flow growth, and net income growth. So if we jump to pillar 3, that is the revenue growth, we can see that that has been increasing quite steadily over the past 5 years at an average rate of 9.33% yearly. But if we jump to the net income tab, we can see that there was a big increase from 2019 to 2020, but since then the net income has been declining by quite a bit, and that is the same case with the free cash flow. Big jump from 19 to 20, and since then the free cash flow has been declining. So we can see that Starbucks has been struggling by quite a bit over the past few years, and one of the main reasons for that is inflation and that people are trying to save as much money as possible and are not going out for as much coffees as they used to. Now, another thing I don't like about Starbucks is their long-term liabilities over the 5-year free cash flow negative dividends, which should be sitting below 1.5, which means that the company can pay off all their long-term liabilities with their average yearly free cash flow within 7.5 years. We can see that the ratio for Starbucks is sitting at 1.67, and they currently have about $23.7 billion in long-term liabilities. And if we jump to our free cash flow tab, we can see that they generate about $3.3 to $3.6 billion yearly. So that isn't enough to cover the amount of debt they have within a safe time frame. So this pillar, along with the declining net income and free cash flow, would all be red flags. Now let's have a look at the 5-year P/E ratio of Starbucks, currently sitting at 28.74, which would mean that Starbucks is overvalued compared to the earnings they generate, where investors pay $28.74 for every dollar of the company's earnings, while for an average company they would pay only $22.5. Now, if we have a closer look, we can see that currently this is sitting slightly lower, but overall the company has been seeing an increase in their PE ratio of 1.63% yearly. So yes, I would consider Starbucks overvalued. Now, if we also have a look at their price to free cash flow, which is sitting extremely high over the past 5 years, but if we have a closer look, we can see that currently that is actually sitting at only 32.45, but that is still higher than what we'd like to see. So again, Starbucks is overvalued compared to their free cash flow as well. Now, the company does have some things that I like. They have decreasing shares outstanding at a rate of 0.77% yearly, and their profit margin is sitting at a decent value at 26.24%. And of course, I also love their consecutive dividend growth sitting at 6.73% yearly. But if we have a closer look, we can see that their dividend increases have actually been declining every single year over the past 5 years. And year over year, they haven't yet increased their dividend at all. So the declining dividend growth is something to look out for. So overall, we know that currently the company has negative growth and that they are valued at a premium which they don't really deserve. Now, something I'm scared about into the future is Starbucks' profitability. Currently, they have a net income margin of 10%, which is more than double the sector median of 4%. But if we scroll down, we can see that the price of green coffee, which is the coffee beans that Starbucks uses for their coffee, has been increasing tremendously over the past years, and that is due to droughts in the countries that produce the most coffee. Now, one thing that bugs me is that by reduced hedging on coffee prices, Starbucks has been betting that in 2025, the price for green coffee will go down, which isn't certain at all. And so if their bet doesn't pay off, their margins will fall dramatically. Starbucks also faces intense competition from Chinese coffee brands like Luckin and Coty Coffee, which is as well expected to pressure Starbucks' US market share and margins. And therefore they don't really deserve to trade at a valuation which is 30 times its forward PE. Now of course Starbucks also has some positives. The coffee industry is expected to grow at an annual rate of 6%, but that doesn't mean that Starbucks will grow at an annual rate of 6%. And of course, their new CEO could drive significant top line growth, and I do think that he will in the future, but he hasn't done so yet. So overall, the outlook for Starbucks is looking quite unresolved. No one really knows what's going to happen over the next few quarters. So let's calculate their intrinsic value and figure out if they are currently trading above or below their intrinsic value. So first, using the Grams formula revised, we plug in the 5-year earnings growth estimate at 16.69% yearly over the next 5 years and get an intrinsic value of $98.29. And take into account that the 5-year earnings growth estimate is plugged in quite high and the intrinsic value is still only 4% higher than the current trading price. Now moving to the discounted cash flow model, we have a look at the free cash flow of the company. We calculate a growth rate of 9.7% into the future, so into the next 10 years plus. Again, the calculated growth rate is quite high, and plugging in a discount rate at 8.3%, we get an intrinsic value of $72.57, which is actually lower than the current trading price. Now for the third valuation model, we want to compare Starbucks to 3 of its competitors, so McDonald's, Yum Brands, and Restaurant Brands International. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios. And we can already see that these PE ratios are lower than the PE ratio of Starbucks. And therefore, when we average them out and multiply by the earnings per share of Starbucks, we get a lower intrinsic value of $76.31. And finally, for the dividend discount model, we take the dividend payouts over the past 5 years, the growth over the past 5 years, and as we know, it has been declining, so I project a growth of 6% into the future, and by doing this, we get an intrinsic value of $105.59, which is slightly higher than the current trading price. And finally, jumping to our ultimate valuation, we average out these 4 valuation models and get an ultimate intrinsic value of $86.33, which is 8.72% lower than the current trading price of the company. And so with a margin of safety of 10%, we get an acceptable buy price at $77.70. So I certainly wouldn't rate Starbucks as a buy. I personally liked it much more after the drop in April and before the huge jump in August, when the company was trading at about $75.29 a share. I believe that if the company didn't jump as much after they announced their new CEO and therefore didn't currently trade at such a high price, they would with the current outlook be a buy, as they would still have a lot of headroom before reaching their intrinsic value. But currently I will have to give Starbucks a hold rating. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.